Alright, so welcome to part 2 of this video where I talk about how do we get great investment ideas from looking at the stock picks of super investors. Now, before we begin, if you have not watched part 1, please pause the video and go watch part 1, where I talk about the fact that we got to begin with our own investment methodology and we don't follow other investors blindly, but we look at what they're buying and we put those ideas through our methodology. And if it meets our methodology, our investment strategy, then yeah, we can get some great investment ideas. So in part 1 of the video, we started by taking a look at the recent purchases of Warren Buffett, our first super investor, and we went through the first purchase, which was Chubb Limited, and I showed you why it did not meet my investment criteria. Let's go on to another stock pick, and this is actually not a new stock pick that he just bought. He bought it quite some time ago, but as you can see, he just added a lot more shares to the stock, which is Liberty SiriusXM Series C. That's a pretty long name. So this company basically is in satellite radio. And again, let's take a look at this stock. Where is that stock? Over here. Okay, great. So again, what do I look at? First thing I look at is I like to look at a company with a track record of historically growing revenue, net profit, and free cash flow. So when the company is able to grow their revenue, profits, and free cash flow consistently, that means the business is consistent, it is resilient, and it's predictable. Because to me, the most important thing about investing is to ensure predictability, that the company can continue to generate more and more money in the long run, so I don't have to worry too much about it. So looking at Liberty Sirius, let's get serious. And if you look at the revenue, revenue has been growing, as you can see, so that's okay. But look at the net profit of this company. Is it growing consistently? No, it's not. You can see over here the profit is growing here. It grew here, and then it went down for 2 years, and then it lost money. Okay, fine, that's COVID, right? Then it went up over here, then it went down. So is that consistently growing? Is that predictable? Is that resilient? No, that is what I call very inconsistent, very unpredictable. 1 year they make money, 1 year they make less money, 1 year they lose money. Very unpredictable. So what's going to happen the next year or the next 5 years? Who the heck knows? So these are the companies I tend to avoid because they're very uncertain. And if you look at the free cash flow, again, is it increasing consistently? Well, it's increasing over here. Then it dropped for 1 year. And then it's been kind of like going down for the last, 1, 2, 3, 4 years of declining free cash flow. Immediately, it fails my investment criteria. Forget it. No point looking at it anymore. All right. And if I look at other things, you can see the return on equity is only 8%. And the return on invested capital is only 5%. So that's way below what I usually look for, which is at least 15% return on equity and return on capital. And you can see their debt to EBITDA ratio is 4.56, which is way above what I'm comfortable with. I want to usually ensure that the debt to EBITDA ratio is less than 3, for example. So it fails multiple criteria. Forget it. I don't care if Warren Buffett bought it. He bought a lot more shares. I'm out. Okay, all right. So that's it. Those are the only ones that he bought. All right, Chubb, Liberty, doesn't meet my criteria. Occidental Petroleum, I already said I don't buy oil companies because they are very unpredictable. Their fortunes depend on oil prices that can go up a lot, can collapse a lot. Very unpredictable. No, thank you. All right. Okay, so let's move on from Buffett and let's see who else we can look at. So in part 1, we looked at Bill Ackman. He had no new buys. We looked at Buffett, and how about Li Liu? Li Liu is someone that Charlie Munger thought was one of the greatest investors in the world. In fact, Charlie Munger gave half his money to Li Liu and put the other half into Berkshire. So yeah, very respected investor Li Liu. And did he buy anything new? No, he didn't buy anything new. So he's holding Bank of America, Alphabet, Berkshire, East West Bancorp, and Apple. No buys, no sells, nothing to look at. Let's see. Down the line, we've got Michael Burry. So I mentioned in part 1 of the video, I don't usually look at what Burry is doing, because Burry is a very short-term trader and he does a lot of investing styles that I don't follow, like deep value, for example. All right. Terry Smith is someone I like to look at. So he likes to buy very high quality companies as well. Terry Smith is known as the Warren Buffett of the UK. All right. And I have had some great ideas from Terry Smith in the past. So let's look at what Terry has been buying in the last quarter. Well, he's been reducing many of his stocks, right? Reducing, not selling all, but reducing. But I tend to focus on what they're adding, all right? So he added Mettler-Toledo. This is not a new stock. He's had it for quite a while, but he just added to this, which is interesting, okay? So let's look at Mettler-Toledo. What do they do? Mettler-Toledo, they basically are into diagnostic equipment. Let me just read the description over here, somewhere down there. Yep. They supply weighing and precision instruments to customers in life sciences, industrial, and food retail industry. So it's very similar to another stock I own, which is Thermo Fisher. And it's basically kind of like a healthcare kind of business, which I usually like. So these stocks are not high growth, they are mid growth, but they tend to be quite predictable and defensive. So let's take a look at Mettler-Toledo, ticker symbol MTD. Does it meet my criteria? Again, I've got a 7-step criteria. It has to meet all my 7 steps before I invest in a stock. But let's look at a few of the criteria. Okay, first, again, track record. Does it have growing revenue? Well, not too bad. Its revenue has been growing pretty consistently for the last 5, 10, 15 years. How about net income? Yep, net income has also been growing. It's also been growing. Slight dip in the last financial year, and that's fine. 1 year drop is not the end of the world, as long as there's a general uptrend, okay? So revenue is growing, net profit is growing. And how about free cash flow? Free cash flow, is it growing? Yep, pretty much free cash flow is growing. Okay, not too bad, right? What else can I look at? Let's look at their profitability ratios. How profitable are they based on their return on capital? So Mettler-Toledo, return on equity, negative equity, because they have got negative equity. And that is not a deal breaker. There are companies I own that have got negative equity, like McDonald's, Domino's Pizza. They've got negative equity, not because they're not doing well. They're doing very well. They're making a lot of money. But basically, they buy back a lot of shares to the extent that their equity turns negative. And that's fine. There's nothing wrong with that. So when a company has negative equity, then ROE doesn't make sense. So we look at ROIC, return on invested capital. And that is 32%. Pretty good. Okay. So pretty good ratio over there. And the debt seems pretty okay, right? Debt to EBITDA ratio 1.79, very safe. Interest coverage 13, very safe. Okay, their balance sheet is pretty strong. What else can I look at? Has this stock beaten the S&P 500 historically? Because if it can't, forget it. I might as well buy the S&P 500. So let's take a look at MTD versus the S&P 500 for the last 5 years. Okay, for the last 5 years, it has beaten the S&P slightly, which is not bad. Okay, pretty good. How about in the longer term? Let's pull it back 10 years. Not bad. It performed, how do I get rid of this? Okay. Last 10 years, it's up 800% versus 300% on the S&P. So it has doubled the S&P 500. I'm getting interested. Looks like a pretty good company, okay? But I want to make sure that the business has a strong economic moat. And nowadays with AI, you can actually use the AI to analyze the business moat, which is what I do. Let me just bring it up over here. Mettler-Toledo. Yep, okay, over here, right? So on a scale of 1 to 10, 10 means very strong and wide moat. One means no moat. I like to buy companies that are at least a narrow to wide moat, preferably wide moat companies. And they have got a moat ranking of about 6, which is a narrow moat, which just passes basically, right? It's not great. I like usually 8, but 6, okay. So they've got some brand loyalty and pricing power, strong reputation for high quality precision instruments, 50% market share, okay? High barriers to entry, so 4 out of 10. High customer switching costs. This is one of their main moat sources, 7 out of 10. Their instruments integrate seamlessly with existing lab workflows and software. Switching to a competitor can be disruptive to their customers and require revalidation of processes, creating a deterrent for customers. So once a customer uses their product, they tend to not switch to another brand. So it's got a pretty sticky factor, which is what I like. All right, network effect, nope. Economies of scale, not bad, 5 out of 10. So generally they do have a moat, but it's not a super strong moat, but it's a narrow moat, which, okay, I don't mind buying it, but I wouldn't like build a super big position on it, okay? But ultimately, again, it may be a good business, but is it undervalued or is it overvalued? So this is where I will do my own intrinsic value calculation, which is what I teach in all my investing courses, my Wealth Academy, Investor Masterclass, and the Whale Investor course, where I teach exactly how to value a stock using my intrinsic value calculator, which is here. So I just did a valuation on Mettler-Toledo, putting in the latest free cash flow that they generate in the last 12 months, the total debt of the company, cash and investments, and the projected growth rate, number of shares, and the discount rate, which I use the cost of equity. And so that gives me an intrinsic value of $1,074. So that is the intrinsic value of the stock. So what is the share price right now? The share price right now is, it's selling at $1,519, 1519. So if I punch that in, 1519, it is overpriced, it's overvalued by 41%, right? So remember, this business, I wouldn't say it's super great, but it is a good business. It is a good company, but a good company, buying it at too high a price when it's overvalued may not make a great investment. So I won't buy it right now, obviously, but I'll put it into my watch list, and I will watch it to see if one day, if the price can drop below 1074, it gets undervalued, then I will start to build a position. All right, so what else did he buy? He bought Fortinet. Okay, I've got Fortinet, so don't need to look at it. Apple, I've got Apple. He bought Texas Instruments. Now, I don't have Texas Instruments, but I looked at it before, and it's an okay company. It's a semiconductor company, but it's not really involved in semiconductors that are fueling the AI revolution. So for me, it's an okay company, but I would rather invest in semiconductor stocks that are more involved in the AI revolution, because that's tremendous growth. Your Nvidia, your AMD, your ASML, your Qualcomm, your Broadcom, for example. So Texas Instruments, meh, all right? How about Choice Hotels? That's a new one. Haven't seen that before. Let's take a look at Choice Hotels. What business could they be in? Maybe hotels. Now, generally, I don't think I would like a hotel stock because, again, it doesn't really have a sustainable competitive advantage, right? Because you can switch hotels very easily. You know, there's not much pricing power unless it's a very strong brand. But let's take a look anyway. So Choice Hotels, by the way, I'm using Guru Focus. I love their layout, so I'm using them to view the financials. Okay, so first of all, let's take a look at the revenue. Yep, looks like it's on an uptrend, not bad. Net profit, is it growing? Not really. You can see here it's like flat, and it's like going down for 3 years. It goes up for 2 years, drops here because of COVID, obviously. But I'm impressed that they still made money during COVID as a hotel, right? And then they recovered, and then it dropped again. So again, that's not being consistent. So they make a lot of money, they make less money. I don't like these companies. They don't grow consistently, the net profit, right? So that's already not too good. How about the free cash flow? Is it increasing consistently, free cash flow? Okay, increases here and drops here, goes up, down, up, down, up, down, down, down. Oh, that's terrible, all right? Inconsistent, unpredictable. No, so it already fails the first criteria, all right? But let's take a look at some other criteria. How about the debt? Oh my God, they've got a lot of debt. Debt to EBITDA ratio, 3.98. That's a bit too high for comfort. And return on equity, ROIC, oh, that's pretty impressive for hotel. They've got high return on equity, high ROIC. So this is impressive, but they fail all the other criteria. And how has does this company have a strong competitive advantage that protects them from competition? Again, I just asked Gemini, and let's see what Gemini says about Choice Hotels, right? So from a scale of 1 to 10, they've got a moat ranking of 5. So yeah, no, I usually want at least 6 or 7 for a narrow moat and 8 to 10 for a wide moat company. It only has 5 because do they have pricing power? Do they have strong brand loyalty that people are willing to pay more for this special hotel? I don't think so. This segment is more price sensitive, limiting their pricing power compared to luxury hotel chains. So it's not a luxury hotel where people are willing to pay more for it, right? They don't have high barriers to entry. Every Tom, Dick, and Harry can start a hotel, right? Actually, they don't have high customer switching costs. You can stay in their hotel one day and switch to the Marriott on another day, Hilton another day, right? They don't have a network effect. So so they don't really have much of a moat, if you will, right? So pass, okay? All right, so what's next? He also bought Paycom software. He added more shares. In fact, he doubled his position in Paycom. It was an existing position, and he added 20% to Oddity Tech Limited. So let's take a look at that, Paycom software. So in case you don't know, Paycom is a fast-growing provider of payroll and human capital management software, targeting clients, small to mid-sized companies. So they compete with other HCM software providers. So again, I'll put it through my investment criteria. The first of which is, again, ensuring it's got a good history of growing revenue, profits, and free cash flow. Now, revenue, you can see it's been growing very well. Fantastic. Net profit has also been generally on an uptrend. Looks pretty good. And free cash flow has also been growing consistently. Wow, passes my first criteria. Not too bad. What else? How profitable is the company? We look at some of the ratios, like return on equity is 33%, and return on invested capital 12%. So that's pretty good as well. How about the balance sheet? Is it a strong company financially? Debt to EBITDA ratio only 0.04. Interest coverage 300. Wow. So this is a very, very financially strong company. Very strong balance sheet. With growing revenue, profits, free cash flow, everything looks pretty good so far. But again, let's take a look at how the share price has performed historically against the S&P 500. Has it been able to outperform the S&P historically? So if I put in the S&P ETF and I compare it with Paycom, and you can see in the last 10 years, it has actually outperformed the S&P 500 by quite a big margin, right? So the S&P delivered 200%, Paycom 900%. In fact, it was up to 3,000% before the big correction that started in 2022 when the Fed hiked interest rates aggressively. So that caused a big sell-off. But even with the big sell-off, it's still outperforming the S&P 500. So yeah, looks like a pretty good stock so far. But does it have a strong economic moat? I like to buy companies with a strong moat And again, I can ask the question to Gemini. What's the moat of Paycom? Is it a wide moat, 8 to 10, or is it a narrow moat, 6 to 7? And it is a narrow moat company, which I am willing to invest in, although I prefer a wide moat, but narrow moat, okay, I may take a smaller position. So they have a decent moat, but it is not impenetrable. So they can get disrupted by competition if the competition is strong enough in the future, but they do have some kind of protection from their brand loyalty and pricing power. That's 6 out of 10. They've got a strong brand among payroll and HR professionals, a user-friendly platform, and some loyalty. However, again, the HR software space is competitive and pricing power may be limited. So there's an extent to which they can raise prices. They are not as powerful as Microsoft, for example, or Salesforce or ServiceNow, all right? High barriers to entry. Yeah, okay, that's pretty high. High customer switching costs. That's also migrating payroll and HR data can be disruptive. So there is some kind of switching costs, but it's not as high as Salesforce or Adobe or ServiceNow. Network effect, not very high. Economies of scale, 7 out of 10. They can leverage economies of scale to bring down their cost and increase their profit margins. So all in all, I would say they have a narrow economic moat. So far, it's not bad. It's a pretty good business, I would say. It's not a super fantastic business, but it's a pretty okay business. But again, very importantly, what's the price? What's the intrinsic value? So I put it into my intrinsic value calculator, and I put in all the latest numbers, which is the operating cash flow for the last 12 months, the total debt, cash and investments, and the projected growth rate. So it's not a high growth company. It's not like a 20-30% growth company. It's a mid-tier growth company, right? So it's more of a predictable kind of business, right? 56 million shares outstanding, and that gives me an intrinsic value of $207. And as of yesterday, let's check it out. Paycom. Okay, as of yesterday, their intrinsic value, their share price is $177. Yep, which I just punched in. So currently it's selling at a 14% discount. So not too bad. Worth taking a closer look at. Not a bad company. It is undervalued. Now, from a technical perspective, if you take a look at the long-term trend, there we are. There's a long-term uptrend, but this long-term trend was broken in 2022 when the Fed raised rates aggressively and we had high inflation. So it has broken that long-term trend and currently is in this kind of like downtrend channel over here. But of course, now if you're trading it, then obviously you want to wait for a reversal of trend, or you're waiting for kind of like a reversal pattern, like a double bottom kind of pattern. Now, as an investor, if you're looking at more of the longer run, then you're looking more at support levels, which you could add shares in tranches. So I've identified there's the intrinsic value at 207. So it is currently slightly underpriced. It's not a big discount, it's a slight discount. And there is a level of support over here from this previous swing low, and another strong level of support over here. So you can see that recently it has been kind of like consolidating within this first level of support. So I think there is a chance where it could bounce back and reverse higher from here. Again, there are no guarantees. If it breaks this level, then I would say the next level would be 107, but I doubt it will go lower than 107. I doubt it, right? So I would say the buy range would be between the current price to 107, within that buy range, if you're looking at it from a longer term investment. If you're looking at it more as a shorter term swing trade, which some of you may, I may even take it as a swing trade personally. And I take a look at the daily charts on a daily time frame, you can see that it's still on a downtrend, obviously. You've got all the moving averages sloping downwards. You've got the 200-day moving average sloping down. You've got the 50 moving average still below the 150 moving average. So as a trader, sure, you could wait for the downtrend to reverse into an uptrend. You could wait for the reversal, right? Wait for the 50 moving average to cross back above the 150 moving average. Wait for them to start sloping up. Wait for higher highs and higher lows, or even wait for the price to get back above the 200-day moving average. You could do that. But by the time that happens, the price would already have rallied 20 to 30%. So generally what I like to do, and even some of my fellow traders or investors, is we like to take starter positions when we see a potential reversal and the beginning of a potential new uptrend. And one of the patterns we like to look at would be double bottom patterns. And this is clearly a potential double bottom pattern over there. So they just announced earnings, and the interesting thing was that they beat earnings, but their guidance was a bit lower than expected. So it gapped down, but it made a double bottom, forcing the stop losses here. This is kind of like a shakeout pattern, and it looks like it could be rebounding back here. So if I choose to enter this as a swing trade, then I'll probably enter it sometime today, but place a stop loss below that swing low, and a profit target maybe somewhere at the 200 moving average that could act as a pretty strong resistance. That is if I take it as a swing trade. And of course, I could execute it using all kinds of option strategies. But if I take it more as an investment, then I would buy maybe a starter position right here. And then if it breaks lower to the second support level, then I'll build a bigger position, because then I'll have a bigger margin of safety for this company. So again, by going through these examples, I hope you're getting an idea of how I look for stocks. I look for stocks all over the place. Sometimes I look for ideas from my students. I look at what my wife is shopping, what she's buying. That's how I got the idea for Lululemon, because she loves Lululemon, for example, right? I look at what I'm buying, what I'm using every single day. I look at what some of the other investors are doing, and then I fit them into my investment criteria, right? Now, of course, I can't cover every single super investor right here, but I'm showing you my process. Hopefully you understand it and you can start to do it for yourself. And of course, if you want me to do it for you, subscribe to my Ultimate Investors Playbook, UIP, which is at insight.piranhaprofits.com, where I'll do all the research for my subscribers, and you can see my live buy and sell notifications every single day, as well as a deep dive on my portfolio every month, as well as a deep dive on the markets, right? Go check out this website, Dataroma, or you can also look at Guru Focus. They compile the 13F filings of all the super investors. And you can look at, again, all the rest of them at your own time. This is from Guru Focus. You can see Stanley Druckenmiller, another great investor come trader. And he recently made some new buys. He bought Daktronics, he bought Coherent Corp, Natera, and Discovery Financial Services, Woodward, Zoom Info Technologies, Flex Limited. So he added quite a number of stocks. So I'll personally be going through this with my team of researchers, going through every single stock. Does it meet the criteria? Does it meet the criteria? If it meets the criteria, I'll be looking to add it to my portfolio. And if it's a good company but not yet at a good price, I'll be putting it on the watch list. And of course, as one of my subscribers and my students, you get to view my watch list and my portfolio regularly, so you know exactly when I'm going to add a great investment in my own portfolio. So hope this has been super useful. If it has, thank you for subscribing, and I'll see you guys in the next video. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.